Good morning, viewers. Welcome to Top of the Morning by Mint, your weekday newscast that brings you five major stories from the world of business. It's Monday, December 2nd, 2024. This is Nelson John. Let's get started. India's market regulator Sebi recently restricted three unregistered online bond platforms for offering privately placed unlisted NCDs to the public. Anshika Kyasta and Neha Joshi write that Sebi has taken this decision due to violations of regulations, which classify any issue with over 200 investors as a public issue. This crackdown was driven by concerns over investor protection and the risks associated with high-yield products. Online platforms often blur the line between private and public offerings, leading to enhanced regulation. India's economy might not be doing so well. The latest GDP growth figures for India indicate a significant slowdown. And Madhavan writes that the latest data shows that growth has now declined for the third consecutive year. At 5.4%, it's much lower than 8.1% the same quarter last year. This downturn is attributed to lower private consumption, investment, and exports. However, the agricultural sector showed a 3.5% increase, showing some positive signs. A weakening rupee could dampen the Indian economy's spirits. Economists have already revised their GDP growth estimates downwards with a consensus of around 6% for the current financial year. Large companies can always be seen clamoring for government subsidies to help their businesses. The central government's production-linked incentive scheme was supposed to do just that. The idea was simple: meet certain manufacturing targets and collect your subsidy. It was successful across many industries such as automobiles, solar, and electronics. However, recent dispersals have decimated from 10,000 crore rupees in 2023 to 24 to around just 1,000 crore rupees this year. Our partners at howindialives.com write that the textile sector in particular is struggling. Firms aren't able to meet production targets, leading to fewer scheme grants. Will India's manufacturing industry be able to pick itself up? Now, a good logo isn't just a symbol. It embodies a brand's identity and values. Every now and then, companies will refresh their brands to stay relevant and appeal to the consumers of the day. However, should you go to an extreme like how the Tata Group-owned Jaguar recently did? Gaurav Lagate writes that Jaguar's rebranding illustrates the risks and rewards of a minimalist logo and ad campaign that led to widespread backlash. Industry veterans point towards more successful refreshes like that of Porsche's, which was a balance of innovation with heritage. Gaurav adds that while visual identities may evolve every 2 or 3 years, major overhauls should be rare and always align with brand strategy. After faltering in China, global luxury brands like Louis Vuitton, Christian Dior, and Hermes were bailed out by wealthy Indians. These companies reported impressive growth numbers from the Indian markets, writes Varuni Khosla. In FY24, Louis Vuitton India saw an income rise of nearly 13%, while Christian Dior's revenue surged by 45%. However, not all brands are thriving. Reliance Brands reported increased revenue, but also a 55% rise in losses. FY25 started off on a challenging note due to a blistering summer and elections, which reduced walk-in traffic at stores. The luxury market in India is expected to reach around $30 billion by the end of 2030. And these brands are waiting for the boom eagerly. That's all for today. Thank you for joining. We're eagerly looking forward to our next Top of the Morning episode, which will be packed with fresh business news. Until then, have a great day.